So this might be a long one. I've had a lot of thoughts stewing in my head for the last few weeks. Some good points, perhaps some of them are useless points, but perhaps the best way to listen to this is not look at my face for the whole time and just play it like a podcast in the background. It's a question everyone wants to know at the moment. Is a property crash looming? If you watch some of the videos coming out of the UK and the US from real estate YouTubers, a lot of them are saying a crash is likely, and there are a few that are saying a crash is unlikely. But how will all these factors impact Ireland, or will they impact Ireland at all? Or will Ireland have its own property crash itself? For first-time viewers, my name is Fleming. I am a chartered property surveyor. I have a degree in property economics. I've been working in real estate for over 17 years. I put a bit of effort into this video, so please go ahead and give it a thumbs up and make sure you subscribe to the channel. Nearly a year ago, I predicted that property prices could fall due to COVID. Some as much as 5%, 10%, and even some property assets could fall as much as 20%. A lot has happened in that year. There has been endless lockdowns, there's been restrictions on construction, restrictions on viewing. There's been a huge amount of government spending in terms of healthcare and government supports. And there has also been a positive GDP due to exports from large multinationals based here in Ireland, particularly in the pharma industry. There's also been an increase in personal savings, as well as a lack of supply of houses coming onto the market. I got some predictions right and I got others wrong. I predicted that office prices would come down, and a lot of them have. Prime offices have kind of held steady. However, there's not enough transactions to paint a clear picture. And in my mind, prime offices aren't providing a great investment at the moment, given the level of uncertainty that's out there in terms of the office market. Perhaps if you're a pension fund or you're a large fund and you can get borrowing for less than 1%, they still make sense, but from a general investment point of view, they don't make a huge amount of sense. Retail has fallen as much as 24%, and hotel valuations has fallen considerably as well. However, there's not enough data in terms of sales volumes to actually paint a clear picture either. Industrial prices rose, so in terms of the commercial predictions, a lot were in line with what people and what I had predicted. What I got wrong was the residential market. There was some areas that did fall in value and other areas did rise in value. What I didn't see or didn't predict was the endless lockdowns, restrictions on viewings, as well as the fear factor from vendors who were fearful of people coming into their house and showing their house, which led to a reduction in supply. I also thought banks would be a little bit more cautious in terms of their lending as well. But at the moment, they still seem to be lending quite freely. 2021 is likely going to be a rough year for commercial property. Granted, there is still a lot of interest in prime real estate and prime locations. However, secondary locations are going to hurt. I feel they're going to hurt quite a lot in 2021. But that's enough in terms of the commercial side of things, because I think most people watching want to know more about the residential and the housing market. So what will happen to house prices over the next year or two? Will they rise? Will they stabilize? Or will there be a crash? The answer is really no one knows for sure, but I don't think it's wrong to provide an educated prediction. Anyone that just says no one knows for sure and leaves it at that, in my mind, is just afraid of being wrong. Counting my 4 years doing property economics and working in real estate, I've been involved in real estate for over 21 years, and I have seen my ups and downs in terms of the market. I recall in my college days learning about kind of property cycles, and in most cases property cycles ran in 7 years. In the early 90s and 2000, Ireland experienced a huge growth in property prices. There was a small little dip in the early 2000s, but generally speaking, Ireland went on a long extended bull run in terms of housing prices increasing. And around 2005, 2006, 2007, there was a lot of people that were very mindful that a crash was around the corner. I was 2-3 years out of college in 2007, and I was getting into arguments with my employer at the time, stating that we were overpaying for sites and none of these valuations stacked up in the slightest, and all the assumptions were wrong. At the time, sites were being valued with a whole host of assumptions that never really made any sense. And there was a lot of people within the commercial real estate market that knew something was going to happen. Just looking at national house prices over the last kind of 15-20 years explains a lot. Prices rose by 14.9% between 2005 and 2006. They rose by 7.5% between 2006 and 2007. And there was a lot of developers out there assuming that house prices would continue to rise like this. They were assuming if they bought a site in 2007 and completed in 2009, that house prices would have increased by 20% over those 2 years. They were building these prices into their valuations in 2007, assuming that prices would continue on this track. This is a totally wrong way to value development land and should never have taken place. And this was all being made possible by Irish banks that were funding these developers at very low interest rates. At the time, there was no international funds that were interested in investing in development land or investment property or housing in Ireland at the time. And I think that's an important thing to remember, and I will get onto it later. So remember that in the last boom, there was no international funds investing in Ireland. Sorry, the lighting was going a bit crazy there, so I just had to pull the blinds down. So what happened next? So prices fell in 2008 by 6.9%. They fell further in 2009 by 18.1%, and 13.4% drop in 2010, and there was a 17.1% drop in 2011, and a further 13.5% in 2012. It's not that there weren't people who wanted to buy property at the time, but they just weren't able to get mortgage approval at the time, and therefore demand was incredibly low. Prices stabilised in 2013. There was a slight national increase of 1.2%. I bought my first house in 2013, and I'm really glad I did, because prices increased by 16.5% in 2014. They went up again by 11.5% in 2015, and 7.5% in 2016, and 10.9% in 2017, and a further 10.2% in 2018. Remember what I said about the 7-year cycle? We were kind of getting to the end of that 7-year cycle, and prices were reaching the top of the curve, and prices only increased by 2.3% in 2019. The likelihood is prices would have leveled off reasonably steady at a low enough price increase in 2020 if we hadn't had COVID. The total growth for 2020 was 0.3% nationally, according to the Residential Price Index. While everyone is jumping all over everyone at the moment in terms of house prices, and every news outlet is reporting that house prices are completely out of control, 2020 has nothing on other years. They've nothing on 2006, nothing on 2007, nothing on 2014, 15, 16, 17 or 18. So let's actually think about this in terms of prices going into the future. Will they go up? Will they go down? Will there be a crash, or will they stabilise? At a very high level, there are 4 main factors from an economic point of view that impact demand and prices. The first one is interest rates and access to capital. Then you have inflation, you also have GDP and unemployment. And these factors impact supply and demand. There also is micro factors in terms of population growth, government intervention, the cost of supply, etc. But let's explore each one of them. At the moment, we have record low interest rates and banks are still willing to lend. That is completely different compared to 2008, when banks were not willing to lend and were increasing their rates. But just so you understand how important interest rates are in terms of how they impact property prices, a 1% drop in interest rates has been proven over studies that it would have an impact of increasing property prices by as much as 10% over the coming periods. And the same can be said if interest rates were to increase by 1%, property values would decrease as much as 10% over the coming quarters. I believe rates will stay reasonably consistent, and hopefully banks will continue to lend. And if that is the case, particularly with the level of increased level of personal savings, demand for housing will continue to increase. And I would say house prices will increase due to this over the next few years. However, as I have been putting my thoughts together on this video, news has broke that KBC are leaving the Irish market, but hopefully that won't have an impact on terms of supply of capital. The next economic factor is inflation. It is an economic factor that has been largely forgotten about over the last number of years, mainly because central banks or the ECB have managed inflation so well that it's no longer on people's radar. A lot of people believe, due to the fact that the US have printed so much money and the European Central Bank have followed suit and billions have been lent to governments, and our Irish government has spent billions, that there is a flood of money in the economy which is going to lead to hyperinflation or lead to high inflation over the next few years. However, when you look at these funds and where they've been spent, the government has spent a huge amount of these funds in healthcare and also providing unemployment support for people who have been less fortunate in these times. So in my mind, I don't see inflation as a major concern right now, and I'm discounting it slightly in terms of impact on housing values. It should be noted that the same happened in 2008. After the 2008 crash, the US pumped a huge amount of money into the economy and printed lots more money at that time. However, inflation didn't run riot at that crash. Basically, a huge amount of the money that was pumped into the economy was kept in large funds, banks, and never really impacted everyday living. The Economist did a good article on inflation last year, and in summary they pointed out that inflation was used by central banks as a tool to stimulate growth. However, central banks have lost this control in recent years, mainly due to globalization and also to the fact that because inflation has been kept reasonably in check for so long now, people don't expect prices to increase all that dramatically. I think companies are also mindful that customers won't be too kind to general prices increasing too much either, and given the fact that there's so much competition out there, inflation has been kept in check in general terms. My two caveats to this inflationary point would be that I'm including all the personal savings that have been gathered over the recent years in terms of access to capital. Also, from a construction point of view, there may have been some skilled labour who have left Ireland, therefore there might be some inflation in terms of construction costs. Also, supply of goods from a construction point of view, there could be some slowdown in supply, and therefore that will lead to some price inflation on construction. However, I'm hoping that is just short term. The next economic factor I'm going to discuss is GDP, which is the gross domestic product. This time last year, it was forecasted that Ireland would have a negative GDP growth rate of 10%. That didn't happen, but Ireland seemed to have bucked the trend. They basically had a positive GDP of 3.4%, mainly thanks to all the funds that the government pumped into the economy, as well as multinationals, tech companies and pharma companies performing extremely well. And we had a positive GDP in 2020. Unlike the rest of Europe, where most countries had a negative GDP of 10%. So Ireland really bucked the trend in terms of GDP for 2020. Ireland is forecasting a positive GDP growth rate of 3.4% in 2021 and 3.5% in 2022. This all points to stable growth within the economy, and that should point to a stable, small stable price increase within house values as well. The next major economic factor to consider is unemployment. Generally, unemployment rates is a very good indicator in terms of house prices, in terms if they'll go up or down. If employment goes down, generally house prices go up because more people have access to cash and more people have access to get a mortgage, increasing demand and ultimately increasing house prices. The same can be said if unemployment goes up and less people have work, there's less people able to afford their mortgage or get a mortgage, and therefore demand goes down and consequently prices go down as well. Unemployment right now is considerably high. It's estimated to be 24% once you include the pandemic unemployment payment. That is a record high in terms of my lifetime or anything I can remember. I think the past record high of unemployment was 17.3% in 1985, and unemployment was at 15.4% in 2012. Neither of those years were great years for property, and property prices were at record lows for those periods. The real impact of unemployment hasn't yet been felt in the Irish economy due to all the lockdowns and all the supports from the government. Once those supports kind of fall away, perhaps there might be a bigger impact, and it could have an impact on property prices. However, much of the jobs have been in certain sectors such as food and beverage, entertainment and hotels. And perhaps once the lockdown is over, a lot of these people will get their jobs back quickly, and people will want to spend some of their savings too. It's important to remember that in 2008, job losses were across multiple different sectors, and a huge amount of young Irish professionals lost their jobs and left Ireland, which reduced the demand for housing in Ireland at the time. This time around, we have a large amount of multinationals trading here and trading very well. They employ over 250,000 staff, and a lot of those staff will get bonuses last year and bonuses this year as well. Generally speaking, high levels of unemployment should bring house prices down. However, I don't think it's going to work just like that this time around. So let's recap. We have low interest rates, access to capital, increased savings. All of this should lead to higher demand and higher prices. We also are discounting the effect of inflation. GDP is running reasonably okay and is forecasted to run at 3.4% and 3.5% over the next few years. This would all, I suppose, would forecast a growth rate or a reasonably steady growth rate. GDP in Ireland bucked the trend in the Eurozone, and we're forecasting a growth rate of 3.4%, 3.5%. This should indicate to reasonable steady house prices growth over the next few years. Unemployment could be at an all-time record high of 24%. This really should be leading to a fairly significant reduction in house prices. However, because those job losses have been very much within certain sectors of the economy, the impact on the housing prices might actually be quite minimal. However, once government supports for businesses and for unemployment drop off, that could have an impact on house prices and consumer confidence. So taking all of these factors into account, the trend would point to kind of stable or small increase in property prices over the next 2 to 3 years. However, let's take into account some of the more kind of macro level economic factors that could play an impact on house prices over the next few years. The first one up is population. Ireland has a growing population trend, faster than most other EU countries, and also we are attracting a lot of tech workers into the country as well. It is estimated that Ireland's population will be over 5 million by 2025. And this will lead to an increase in demand for housing, both from an owner-occupier point of view and from a rental point of view as well. This growth in population, along with a demand for rental properties, is leading to a lot of pension funds and foreign investment funds investing in Ireland, buying and building apartment blocks to rent them. These type of funds have been doing this probably for the last number of years, probably started at a small scale in 2013 and have continued to grow their portfolios here in Ireland. Remember at the start of the video, I said that developers were funded by Irish banks in 2008 and no international funds were coming into Ireland at the time because everyone outside of Ireland was expecting a crash. Well, unlike 2008, the international funds and pension funds are still very much interested in investing in Ireland, particularly within the residential market. And I think that is a very big difference between now and 2008. Ireland was out of control in 2006 and 2007. Personal debt was huge, and you could get a mortgage, 105% mortgage in 2006, 2007. You could go buy a house and a car and furnish it all at the same time. Banks at the time were offering funding to multiple developers, all bidding for the same site, which was pushing up the values of those sites as well. I remember being in Brazil around 2006, 2007, and I was in an architect's office. There was far better value in Brazil at the time, and he asked me what the Irish property market was like at the time. I recall informing him about a recent development deal that happened in Ballsbridge in Dublin 4. It nearly took the wind out of him and he fell back into his seat. A few moments later, he picked up a pen and a notepad and scribbled a few things down, and then looked up at me in amazement and said, "That is crazy. Ireland is insane. Those prices per acre are more expensive than Manhattan." I just nodded back at him. I didn't know what to say, but I'm not quite sure if prices were more expensive than Manhattan at the time, but they certainly were comparable. Even thinking back on some of the development land deals that happened in 2006 and 2007, a lot of them still have yet to be developed or even a sod to be turned. The Gas Bottle Works site sold for over 400 million, and 14 years later, nothing has happened on it, and it sold there a few months ago for around 200 million. So I think that just shows that we're not at the kind of levels that we were back in 2007 and 2008. Any economist that tells you it's 2008 all over again does not know what they're talking about. This time round, Irish banks aren't heavily involved in major development deals or major investment deals. Most of the funding is coming from foreign investment. So therefore, the Irish taxpayer is not on the hook. There will be no NAMA 2, and there will be no calls from the government at midnight to bankers wondering about fears of liquidity within the banking network. Government intervention can also have an impact on demand and supply. The Help to Buy scheme and the Shared Equity scheme, while both schemes have been designed to help improve supply, they actually have a bigger impact on the demand side, and as a result they increase prices. I have done another video on that, and I will leave a link below. I explain why that happens in Ireland. The councils are also buying up a huge amount of properties as well, which is having an impact on the demand side. They're competing with private individuals to buy up houses, which I don't agree with at all. Also, in terms of the council renting properties on the HAP scheme, they're renting a huge amount of properties, private properties that could be sold on the private market. However, they're renting them as part of the HAP scheme, which is fair enough, but I don't think it's the right way to provide properties in terms of social housing. These houses should be on the open market and open to the public. Councils rented over 17,000 units for the HAP scheme alone in 2020. These houses perhaps would have been sold on the open market if the HAP scheme didn't exist. Government lockdown on building sites and viewing restrictions are also having an impact on the construction side. There is going to be delay of housing in terms of delivery dates, but it also throws up a few other issues as well, not just in terms of delivery dates. Many construction workers are on contracts, and a huge amount of them will have left Ireland to seek jobs elsewhere during these construction lockdowns. So hopefully we are able to get construction workers back once these lockdowns end. The next major concern I have is developers will have had to face mounting interest bills as their sites have been delayed, and those bills are probably in the millions across the industry. These costs will be passed on to the buyer in some way. Or perhaps developers right now are looking to reduce their risk and they're looking to forward sell the development onto a pension fund or an investment fund that is looking to rent the entire development out. And you can't really blame developers for taking this option to reduce their risk, given the amount of uncertainty that is out there in the market, or perhaps there could be further delays in construction. If they can somehow manage to reduce their risk or forward sell it, because who knows what might happen in 2-3 years in terms of property prices, and they may need to get out of the situations they are and de-risk. And in a lot of cases, the easiest way to de-risk in some of these projects is to forward sell it to a pension fund or an investment fund that's looking to rent these units out. The government's ban on viewings has led to a lag in terms of properties coming onto the market, and that is going to take a number of quarters to get back in terms of a supply point of view, which is ultimately going to have an impact on supply as well as price. All of these elements will have an impact on reducing supply and will ultimately lead to an increase in prices. So far, everything other than high unemployment has pointed to increased house prices, or at least a stabilisation of house prices. The fundamentals in Ireland at the moment are that at least we're looking at stable prices for the next year or two. So why is everyone talking about a possible crash? Well, the Irish government have borrowed a huge amount over the last year or so, and that is all going to have to be paid back at some point, and taxes are going to have to be raised to pay that back. Raised taxes lead to less buying power, which ultimately has an impact on the demand side. However, Ireland is borrowing at such a low rate, I actually think the government should have the ability to manage these repayments reasonably well, and it may not have a major impact on the demand side. A stock market crash in the US would lead to a fallout in Ireland in terms of property prices and would reduce house prices and confidence as well. And once confidence is eroded a little bit, there will be less demand and ultimately there will be lower house prices. However, Goldman Sachs are predicting an 8% growth rate in the US this year. I'm not a trader and I don't quite understand the stock market as well, anywhere near as well as I understand property. But I'm hoping that an 8% growth forecast for the US, and the fact that 25% of the SP 500 is made up just of a handful of like 6 or 7 or maybe 8 tech companies that are performing really well at the moment, will kind of minimize any kind of fallout from any kind of a stock market shake. Biden's tax plan to force US companies to move some of their operations or move some of their profits back to the US and away from places like Ireland would definitely damage confidence within Ireland. It would lower Ireland's GDP and would weaken demand for investment in Ireland, which would ultimately have a negative impact on property prices. A lot of the US videos from YouTube talking about property all talk about forbearance and a growing numbers of houses or mortgages in forbearance. However, that has happened a huge amount because of changes within the law in the US due to COVID that have allowed people to enter into forbearance without losing their homes. In Ireland's case, the numbers are actually different. The number of mortgages in long-term arrears actually fell in 2020, and we don't seem to have any major mortgage crisis at the moment in Ireland. Granted, that might change a little bit once government support's fallen, but the data that's there at the moment is that there is no crisis, and the number of properties or number of mortgages in long-term arrears actually fell last year. There are a lot of unforeseen events that could bring about a market crash. However, right now, the main indicators are pointing to perhaps a slight growth or at least a stable price increase over the next year or two. None of them right now, other than high levels of employment, which might have a very minimal impact in terms of the overall economy, is pointing to a crash. So therefore, I'm not quite sure a crash is likely, certainly not in 2021. The likelihood is we might have a small amount of growth in 21, but I really don't think a fall in 2021 is likely. Property prices have probably increased so far this year by about 0.07%. If you watched the video all the way through to this point, I want to say thanks a million. I'd love to hear your comments below in regards to what you think. Also, if anything in this video has changed your mind in terms of your outlook, please let me know in the comments as well. It does take a little bit of effort to put these videos together, so if you liked the video, please give it a thumbs up. Also, don't forget to subscribe to the channel. If you know anyone, friends or family that you think might find this video useful, please go ahead and share it with them. And as always, I want to say thanks for watching.